It's 6:47 p.m. on a Thursday evening. Sarah's staring at her laptop screen, scrolling through her company's open enrollment portal. The premium numbers don't look right. They're higher. Much higher. She triple-checks the math. Her family's health insurance premium just jumped $400 a month. That's $4,800 a year gone before her paycheck even hits the bank. Sarah's not alone. Across America right now, millions of workers are logging into their benefits portals and discovering the same thing. 2026 is the most expensive year for health insurance in over a decade. But here's what most people don't know. Buried in this year's enrollment paperwork is a quiet policy change that could save you thousands, if you know where to look. Today, we're breaking down what's driving this cost explosion and the HSA strategy that might help soften the blow for your family's bottom line. Let's start with the numbers, because the numbers are brutal. According to a recent Mercer survey, employer health benefit costs are expected to rise between 6.7% and 10% in 2026. That's the highest increase in 15 years. The last time costs jumped this sharply was 2011, right after the financial crisis reshaped the entire healthcare landscape. For the average employer, that pushes total healthcare costs above $18,500 per employee. Every single year. And here's where it hits your wallet directly. Workers will pay 6 to 7% more for their employer-sponsored health insurance in 2026. That's more than double the current rate of inflation. So your groceries went up 3%, your rent maybe 4%, but your health insurance? 7%. Year after year, healthcare outpaces everything else in your budget. Now employers aren't just absorbing these increases, they can't. Most companies face the same math problem Sarah discovered on her laptop screen. According to Mercer's survey, 59% of employers will make cost-cutting changes to their health plans in 2026. That's up from 44% just 2 years ago. What does cost-cutting look like in practice? It means higher deductibles, bigger copays, more of the financial risk shifts from your employer's balance sheet onto yours. Think about it this way. Your monthly premium is just the cover charge. The deductible is what you pay before insurance kicks in at all, and that number keeps climbing. But here's the part that caught my attention when I was researching this episode. There's a specific reason costs are spiking so dramatically right now. 3 letters, GLP. GLP-1 medications, you probably know them as Ozempic or Wegovy, have become the single largest cost driver in employer health plans, and it's reshaping the entire insurance market. According to Blue Cross Blue Shield, covering these medications for weight loss could drive employer premiums up by as much as 14%. 14%. On top of everything else. These drugs work. The clinical evidence is remarkable. People are losing 20% of their body weight, reducing heart attack risk, managing diabetes better than ever before. But they cost over $1,000 a month per patient. Multiply that by millions of prescriptions and you've got an insurance crisis that nobody planned for. Some employers are pushing back. Only 19% of large employers currently cover GLP-1 drugs specifically for weight loss, though that number rises to 43% among the very largest firms. And here's where the coverage lottery begins. Your coworker on a different plan might have Wegovy covered. You might not. Same company, different outcomes. It depends entirely on which plan your employer picked. According to GoodRx's research, 12 million Americans lost commercial insurance coverage for Wegovy between 2025 and 2026. Another 12 million lost coverage for Zepbound. The rug got pulled out. So we've got rising premiums, higher deductibles, and medication coverage that changes year to year. Not exactly reassuring when you're trying to plan your family's healthcare budget. But and this is important, there's actually some good news buried in the 2026 changes. And it's something most people are going to completely overlook. Starting in 2026, every single bronze plan and catastrophic plan on the healthcare.gov marketplace automatically qualifies as HSA-eligible. This is huge. This one policy change expands HSA access to 7.3 million additional Americans who couldn't use these accounts before. 7.3 million people who now have a new tool. Now, if you're not familiar with HSAs, health savings accounts, let me explain why financial planners sometimes call these the most powerful savings vehicle in the entire tax code. An HSA gives you what's called triple tax advantage. You contribute pre-tax dollars, so you lower your taxable income. The money grows tax-free. And withdrawals for medical expenses, also tax-free. That's 3 separate tax breaks on the same money. No other account, not your 401k, not your Roth IRA, not your 529, does that. The HSA stands alone. Here's why that matters right now. If your employer offers a high-deductible health plan with an HSA, you might want to seriously consider maxing out your contributions for 2026. The 2026 contribution limits are $4,400 for individual coverage and $8,750 for family coverage. If you're 55 or older, add another $1,000 in catch-up contributions. Now, I want to be careful here because everyone's situation is different. Your income, your health needs, your risk tolerance, they all change the math. But historically, the HSA has been a powerful tool for those who can use it. The catch, and there's always a catch, is that HSAs require you to be enrolled in what's called a high-deductible health plan. And that word high-deductible makes some people nervous. Rightfully so. A high-deductible plan means you pay more out of pocket before coverage kicks in. If you have regular prescriptions or chronic conditions, the math might not work in your favor. That's why open enrollment isn't just about comparing premiums. You might want to calculate your total cost of ownership, premiums plus deductibles plus expected out-of-pocket expenses based on your actual health needs. Here's a framework that might help. Take last year's medical expenses, add them up. Then compare 2 scenarios, your current plan versus a high-deductible plan with maximum HSA contributions. Factor in the tax savings on those HSA contributions. For someone in the 22% tax bracket, maxing out a family HSA saves about $1,900 in federal taxes alone. And here's the part that surprises people. You don't have to spend your HSA money this year. You can invest it and let it grow for decades. The account is yours forever. It follows you from job to job. Unlike a flexible spending account, the FSA, there's no use it or lose it deadline with an HSA. The money compounds year after year. Some people treat it as a stealth retirement account. After age 65, you can withdraw HSA funds for any purpose without penalty. You'll just pay regular income tax like a traditional 401k. Before 65, non-medical withdrawals get hit with a 20% penalty. So one strategy some financial planners suggest, and again, check with your own advisor, is to pay current medical expenses out of pocket and let your HSA grow untouched for as long as possible. That's the long game. But let's talk about the immediate situation. Because you've got decisions to make in the next few weeks and open enrollment waits for no one. Here's what I'd suggest reviewing during this enrollment period. First, consider pulling last year's explanation of benefit statements. Add up what you actually spent on healthcare, not what you expected to spend. Second, you might want to check if your prescriptions are still covered under each plan option. Drug formularies change every year. A medication that costs $10 could suddenly cost $200. Third, consider looking at your doctors. Are they still in network? Network changes happen quietly. Your family physician might cost you 3 times more if they got dropped from your carrier's preferred list. Fourth, and this is the one people forget, consider whether GLP-1 coverage matters to you. If you're currently on these medications or considering them, coverage varies wildly between plans. SHRM's employer survey found that the GLP-1 coverage question is now one of the top factors driving plan design decisions. Your employer is definitely thinking about it. You should be too. Now let me address something I know some of you are thinking. This feels overwhelming. All these numbers, all these trade-offs, all these what-ifs. I get it. Healthcare shouldn't require a finance degree to navigate. But here we are. The system is what it is, and your job is to work within it as strategically as you can. If all this feels like too much to process alone, it might be worth considering a consultation with a benefits advisor or fee-only financial planner. 1 hour of expert guidance could potentially save you thousands in bad plan choices. And look, I know that costs money too, but the difference between the wrong health plan and the right one can easily run $5,000 over the course of a year. The math tends to favor getting help. Let me bring it back to the big picture. We're looking at the steepest premium increases in 15 years. Employers are passing more costs to workers. GLP-1 drugs are reshaping the entire insurance marketplace. But in the middle of all that disruption, there's an opportunity. The HSA expansion means millions of people who couldn't access these triple tax advantaged accounts now can. Whether that opportunity works for your specific situation, your health needs, your income, your family circumstances, that's a calculation only you can make. But now you know the option exists. So here's my challenge to you. Before your enrollment deadline passes, spend 1 hour. Just 1 hour. Really digging into your options. Not skimming. Actually comparing the numbers. Pull up your plan documents. Calculate your total expected costs under each scenario. Factor in the HSA contribution limits if that's available to you. Run the math like your family's budget depends on it, because it does. And if this kind of breakdown helped you think through your enrollment decisions, consider hitting subscribe. We cover stories like this every week, the numbers behind the headlines, and what they actually mean for your wallet. Remember Sarah from the beginning of this episode? Staring at her laptop, watching her premium numbers climb? She's got the same choice you do. Panic or plan. The next few weeks are your window. Use them wisely. Your future self, the one writing checks for medical bills in 2026, will thank you for the effort you put in today. Now, this content is for educational and informational purposes only. It's not financial advice. Your situation is unique, and you should absolutely consult with qualified professionals before making major decisions. That's all for today. I'm your host at Money Moves Daily. Now get out there and make your health insurance work as hard as you do.